my pleasure to introduce our speaker for today, David Ng. With years of experience in the derivatives industry, David is a seasoned expert in this field. He previously served as the head of marketing in Philip Futures, where he led the marketing team in driving growth and development of the derivative industry. Currently, David is a full-time proprietary trader with Iceberg X, a local proprietary trading firm. He brings a wealth of knowledge and expertise to our session today, and we are thrilled to have him share his insights with us. So without further ado, I am delighted to hand over the presentation to David.
Just before I start, just like to thank Excellent as well as Bursa Malaysia Derivatives for hosting this platform and inviting me to speak on today's topic. As what CY mentioned earlier on, I think gold has been very interesting topic, at least for the past 2 weeks or so. And I think obviously a lot of people will be asking, what is the opportunity that we can gather from the gold market? Now, probably you may aware or may not aware, I think just September last year, I think it was 19th September, Bursa Malaysia Derivatives did indeed actually revamp the gold contract. There's a new contract specification that's in town that's based on the US dollar price rate, which is good for us, especially if you are trading on the local front. It's very headache sometimes to be converting US dollar to ringgit just to get a conversion, and in order for you to make that trading decision, sometimes it gets very difficult and quite tedious. So I think Bursa Malaysia acknowledged that kind of challenges, and indeed they came out a revamped FGLD contract, and I think it's definitely beneficial for the audience at large. And I think later on I just will be touching a bit on the contract specs. So you have not familiar with the FGLD market, I think it's a good time for you to get exposure, especially in the gold market in general. So this is the agenda for today. I think before I present this slide, that was way before the SVB crisis, the banking crisis in US actually exploded. So I think gold took a massive rally because of that banking crisis. But indeed, I think you just look at technically and fundamentally, just before the start of this year, 2023 looks like it's set to be a good year for gold in general, and not only for gold. You look at commodities in general, it's going to be a quite a interesting year going forward. Now, being a trader in the market, there is always a saying, fundamentals sometimes may not be useful. Whether I disagree or agree, that is aside. But importantly, being a trader and being a financial analyst in the market for quite some time, I think it's important for us to incorporate both fundamentals and technicals when it comes to trading perspective. Obviously, technical helps you and aids you when making trading decisions, but fundamentals will give you an overall picture as to how the commodity, perhaps in this particular case, gold, has performed fundamental wise. So obviously, I'll discuss some of the key factors that you should watch out if you are trading the gold market. Some of these factors are important to take note because these are all having a direct impact with gold prices. Now, obviously, if you are someone that has been watching the gold market and you're also watching the equities market, you probably have noticed that every time when equities face a slump, enter into a bear market territory, normally gold will tend to be a very good beneficiary. So I'm not saying that if you are in the equity space, it's time for you to let it go. But it's also it's a good asset diversification, as I'll share on later on the slides. Why do I mean that? And I think it's important if you are looking at something to diversify your equity exposure. I think gold is quite a good asset class to look at. Now, being a trader, obviously we need to understand which is a good entry price and exit price when it comes to entering a particular commodity, and in this case gold. So I believe that with technical outlook, by looking at charts, that enable us to make better decisions as to when to enter a particular price and when to exit a particular level. Obviously, you can see a short-term rally in gold prices. The key question is whether the short-term rally that we are seeing in gold prices, can it sustain, at least for the medium term. Now, last but not least, like I mentioned earlier, if you want to gain exposure in the gold market, fear not. I think BMD has actually revamped a new FGLD contract, which is, it creates a lot of opportunity, for local traders, especially for us, to gain exposure in the gold market. So before I start, as usual, a risk disclaimer. So anything I presented here or opinions as presented is purely based on my own. It doesn't reflect, any recommendations or opinion from basically, the organizers themselves. So, dealing with derivatives does involve a lot of risk. So make sure you consult any licensed representative, and especially from a licensed broker, licensed by Bursa Malaysia and SC. So make sure before you start your trading journey, consult with the professionals. And obviously when you start trading journey, there's a lot information overload. So be selective, and obviously to kickstart your journey, be as simple as you can. So I think that with that, we can start our presentation. Now, the reason I showed this slide is just to give an overview of some of the key aspects that we're looking at. Why 2023 is a year that we should be looking forward positively when you look at gold prices. I think firstly is that when you look at this year itself, when you enter into 2023, a lot of projections are saying that this year is going to be a better year compared to 2022 because a lot of countries has already reopened, and the good news is China is really starting to reopen. So in terms of growth, economic growth is supposed to be good. And when you have strong economic growth, when economies are doing well, normally gold is not favored because golds are usually, we call it a very old asset class where when things don't go well, you go into gold market. That's why it's called a safe haven asset. So naturally, when you have strong growth projections in the economy, that will be not beneficial for gold prices. And indeed, we saw that. If you look at gold prices early this year, back in January this year, I think gold prices were actually languishing about $1,700, $1,800 per ounce. But that story has changed. Now, really, I think you just look at just a couple of weeks back, economies are starting to turn for the worse. If you just look at US itself, a lot of indicators are pointing to slower economy. And not only in US, if you just look at other major economies like even China itself, despite their reopening, their numbers and momentum starts to show that there's a declining pace in their momentum. So all these indications are telling you that global economy, although we started the year with more positive outlook, but going into the second half is quite challenging, and that is where it poses something that is a bit of narrative that supports the gold prices. So I think really it's both to watch out. The second half of this year is going to be very interesting for the gold market. Personally, I think that if you are trading the market, now is a very good time for you to really look at the gold market. Because if you are a trader, you like volatility. You don't want to trade a market where it's actually very stagnant. Sometimes the range is very small, and that usually won't present you much opportunity. But gold is different this year. I think gold, if you just look at the prices just a couple of days back, every day you're talking about $10, $20 movement in the gold prices easily. So that's where we are going to see, at least for the foreseeable future, and we should get excited about it. So touching a bit on commodities in general. Now I'm a very big fan of commodities. I've been trading commodities, particularly in grains, in obviously Malaysia we trade the palm oil market. So gold is particularly also part of commodities. It's a precious metal. Now, commodities in general, if you compare to equities, it has actually been performing well. If you need an asset class that actually, give you good return, look at commodities. It was actually performing well since the second half of last year, right until where we are till today. So I think the key question is that as equities becomes a tougher asset class to invest with or to trade with, commodities gives you a bit of a bit more leeway. Now, not all commodities are the same. If we just look at the performance in the commodity basket itself, obviously, I think you trade mainly the soft agriculture like coffee prices, even sugar prices. Those commodities are actually experiencing all-time high moments. And in fact, that's why inflation is finding it very difficult to come down, because imagine, you be prepared to pay your next Starbucks of coffee higher price, because the price of coffee and sugar is still on the high side as compared to palm oil. We've seen the high last year when palm oil was trading about 8,000 ringgit. Obviously, we don't seen those levels this year, and actually retreated quite dramatically over the past couple of days. So really the question is that a lot of these major commodities has actually experiencing declining phase, except for a few several particular commodities which is doing very well, especially the soft agri. and in particular your coffee and sugar. Now the rest of it, if you look at crude oil, and whatnot, I think those prices has actually came down a lot. So eventually, what this tells you is that inflation shouldn't be so stubborn. It should adjust on a downwards basis. The problem is that whether the pace is going to be quite rapid or not, I think that's another question. But keep in mind, I think if you are in the commodities overall, it's still outperforming the equities market. But not all commodities are the same. There's only selected commodities that do well. The rest of it are experiencing quite a downtrend market in certain categories. Now, gold being as it is a precious metal, it has a lot of function. And if you look at it historical perspective, I think gold has performed well. If you compare to the correlation between gold and other asset classes, correlation means here refers to the movement between gold and other asset classes. So every time when you see gold prices, tend to move quite strongly, quite positively with, especially with US Treasury. So if prices of gold goes up, it can obviously US Treasury tends to go up as well. Now the key thing is that when it comes to equities market, generally, it's been known that every time when there's a bear market in place, gold tend to be favored. We have seen that historically. Obviously, recent times we've seen a bit of strong positive relationship between equities market and gold. Now, as a trader, you cannot use this relationship as like set in stone. Obviously, these markets are dynamic. There's always factors that change it. So relationship between these two asset classes are also dynamic. There will be a period of time where both of them move in parallel, but there's also time where they move inversely. So as a trader, we only can use this as a guide. So whether you're hoping that, if you see treasury rates are going up, you tend to see stronger gold prices. That may not be the case. Keep in mind, there's a lot of other dynamic factors that can change gold prices. So that's something that we have to take note. If you are someone that's watching the gold market, obviously you cannot just deduce certain factors and assume that gold prices will tend to move alongside because of these factors. Keep in mind, these are all historical relationships. So whether historical will repeat is another question. But it serves as a guide for us. So keeping in mind, I think just looking at this table, you can clearly see that when it comes to equities market, there's not much relationship. And obviously against crude oil, it tend to move on the inverse relationship. So with that, I think probably you can clearly see which are if you are holding an asset classes, for example, and you want to hedge against your equities exposure, I think gold can be a very good asset classes to look for. Now, I just want to share this chart, basically comparing gold prices and copper prices as a ratio. The reason I want to indicate this ratio is that every time when the ratio declines, it tells a lot. It tells a big picture. What this tells you is that every time when this ratio declines, that means copper is underperforming. Now, copper, is an industrial metal. Everyone knows that, the world needs a lot of copper. So when economies do well, demand for copper goes up, and naturally prices also goes up. So obviously when copper prices are good and assuming gold prices is stable, that ratio tend to be a bit is going to be high. But when that ratio decline, that shows you that the copper price actually decline faster than gold prices. So right now we are seeing that we saw that back in 2020 when at the start of the COVID-19 pandemic, we saw that ratio actually decline. That shows you that actually gold is outperforming. Now, if you look at the ratio currently, I think there's a slight decrease, but the overall trend still pointing sideways or probably down. There's a more downward bias. So what this tells you, if you compare to copper, which is always related to economic growth, as long as copper is not performing well and copper prices tend to fall back with gold prices, it tells you there's a lot of upside for gold and there's a bit of downside for the copper market. So I'm not saying that you should watch out this ratio closely, but it gives you a gauge as to which particular metal is heading north and which particular metal is heading south. So with that in mind, I think copper is a very good indication as to where the economy is going to go. If copper prices continue to decline and gold prices starts to go higher, this ratio is going to go further down, and that will tell you that copper is way underperforming, and this gives you an indication as to how strong the global economy growth is going to be. Now, what I did here is that comparing, gold prices with Dow Jones. Sorry about the color of the lines. It's a bit misleading. But the gold color line is basically to show you gold prices on COMEX, and the red and green candles is just to indicate you Dow Jones prices. So you can clearly see from here is that every time when Dow Jones start to decline, there's a massive correction in Dow Jones. We saw that back in 2008 during the global financial crisis. You can see how strong the rally in gold prices stays. Again, we saw that in 2020, at the start of early 2020, at the start of COVID-19 pandemic. Again, we saw the similar action. We saw massive plunge in Dow Jones index, and again, I think you can clearly see gold prices tend to be supported during that time. So this tells you, generally in a very bearish market, especially relates to equity market, we tend to see gold prices tend to be favored. So the key question we should ask ourselves is equity markets heading into further downside? If that's the case, I think that will, historically speaking, that will give a bit of support for gold prices going forward. Now, I like to do things or look at things when you compare two different various asset classes or two different aspects in terms of ratio. So what I did here is comparing Dow Jones against gold prices in terms of a ratio. If you notice, every time when the ratio starts to go down, that tells you that if you just take this ratio as a reference, it shows that gold is outperforming compared to Dow Jones, and that usually indicates that the market is heading to downward correction. Now you can clearly see now we are at the critical point of this Dow Jones and gold ratio. If this ratio continue to decline, that tells you that Dow Jones is entering into a bear market phase, and that's beneficial for gold. So I think all these indications are pointing to you that gold may have a bit of support, going forward. And I think this all points to how economy is going to perform in the next couple of weeks or months or so. Now, just touching a bit on equities, I think given the fact that clearly we see a lot of indications are pointing to there's weakness in the economy, there's weakness in the index itself. Now, when you look at economy fundamentals, I think it's all pointing to you that things are not looking rosy as it is. First thing is that interest rates are no longer cheap. If you look at it, we are way past zero interest rate environment. And with this kind of environment, I think higher interest rate is going to cause a lot of pressure. Obviously, we saw over the weekend there's banking crisis that happened in US. I think that really causes a sharp panic with a lot of investors flowing back into safe haven asset, and gold is the ultimate beneficiary. Now, you just look at the chart on the left. It's important to highlight to you is that in US markets, the margin debt is actually very high. A lot of investors that trade US stocks, they use a lot of debt financing. And these are all good and rosy when you have low interest rate environment. Now, things are changing. You are no longer in low interest rate environment. You are in actually a high interest rate environment. And the rapid increase in interest rate actually caused a lot of cost pressure for these investors. So as a result, a lot of these investors, because of higher debt financing, higher debt costs, they have to liquidate their stocks. And that will push down the index. And that's what we are seeing now. There's a lot of deleveraging happening, and that put a lot of pressure on the index. So it's a good thing. It's a good sign for the gold market, as long as the index is coming down. It's supportive for gold. Now, besides the index itself, we just look at other hard data like US home sales. Now, January is probably, like I mentioned, even when we enter the new year, we enter with optimistic feel, but that changed dramatically over the past couple of weeks. So obviously the data on January is still looking rosy, but that quickly has changed over the past couple of weeks. We just look at the latest home sales. I think the figures are actually showing you declining rate. Now, these are pointing to you sentiments in the market. If investors are not positive because of the economy, it's not showing you positive signs, I think that will tell you a lot of picture on how the next couple of months will go by. Now, I'm not going to touch too much on global trade, but what this picture tells you is just showing you the Baltic Dry Index, which basically showing you the shipping rate, shipping your goods between countries, between continents. If you can recall, back in 2020, at the peak of the COVID-19 pandemic, a lot of restriction was in place. I think that time when we were trying to ship a cargo from US to China, it actually cost you, as compared to prices now, it's almost triple or quadruple. But that again the prices have actually slumped dramatically. Now this is pointing to you signs that global trade is actually slowing down. That's why there's not much demand. Supply is abundant because if you recall last year, what was the major theme? If you attended some or even read on the news, last year every country was facing logistical nightmare. There's supply chain issues that pushes inflation to very high levels. But I think that has eased. There's no supply chain issues anymore. Countries are already reopened. So really, I think shipping rates are already fallen to levels even before the pandemic. So this goes to show that global trade indeed is suffering, and we don't see the kind of demand that we used to see back in 2021 or 2022. Then this is concerning. As long as global trade is not improving, it's telling you that the world is not doing any better. So really, if you are watching closely on how things are improving, take a look at the global trade. Usually it's the first sign to tell you that if things are getting better, global trade should show you a bit of sign of life in terms of better numbers. But we don't see that in the moment. I think that's crucial to watch, at least for the next couple of months. Now, I think clearly, if you look at some of the leading indicators, leading economic indicators in US, it's pointing to you that the economy is suffering. Just that GDP growth still maintaining at it's a tad above last numbers, but let's see the next couple of quarters. I think that would severely change if things doesn't improve, at least for the next couple of months. So really, I think economics indicators are pointing to you things are not looking that good, and all this should be beneficial for gold prices in the near term. Now, you just look at yesterday. If you stayed up, right to the early morning, you probably have noticed Jerome Powell's speech is that the expected hike of 0.25 basis point, US Federal Reserve 25 basis point and Federal Reserve rates is expected, and it's based on a lot of numbers. I think the unemployment numbers in US is still looking very rosy, but again, those are headline numbers. If you dig those figures closely and you go on the underlying figures that's actually explaining those numbers, actually paint to you a slightly different picture. Now, if you read through past couple of days of news, you probably have noticed that there's a lot of tech layoffs that's happening, especially coming from the big fours like Google, Facebook, Meta, and other major big companies. Now, this is crucial. Obviously, with such a huge layoff, it has not translated into those general unemployment numbers, but it will. The key thing is that as long as every quarter you start to see there's more and more layoffs coming from these tech companies, eventually it will translate into higher unemployment numbers. And that's crucial, because if things are not looking well in employment aspect, that really should put a lot of pressure on US Federal Reserve to do something. And eventually with that will have an impact on gold prices. It may not have a direct impact, it will have an indirect impact when it comes to interest rate and any other economic factors. So all these variables are important to watch out and worth to look at closely in the next couple of weeks or so. So again, this is trying to paint to you the employment figures in US. It does look not so rosy, despite you're seeing all-time low in unemployment numbers. But if you go the underlying, you look at job placement and even the tech layoffs, those are telling you a slightly different picture. So continue to watch this space. I think that will give you a bit of hindsight as to where really the economy is heading for the next couple of weeks. So now what I conclude here is basically a list of factors that actually affect gold prices directly. But again, like I say, this list is not exhaustive. There's a lot of other dynamic factors that can affect gold prices. So keeping in mind, every time we look at commodities, gold is still a general commodity. Whenever you discuss about commodities, there's always back to demand and supply. If you have a commodity that is great in demand, but supply doesn't increase much, probably you expect prices to go higher, and vice versa. So the demand supply equation still plays an important role when it comes to gold prices. But there's a lot of other prevailing factors that's actually more important whenever we are discussing about gold prices. So I think first thing is that look at the dollar index. If you look at the dollar index and you compare with gold prices, there's obviously a reverse or inverse relationship between these two. You have a stronger dollar, normally it's not beneficial for gold prices in general. Now, interest rate is another important factor. Now, interest rate affects your dollar, then indirectly it affects gold prices. So interest rate is an important factor that worth to consider whenever you are trading in gold prices. Now, if you look at interest rate per se, taking it as a factor. Now, as a trader, you know, when it comes to interest rate decision like yesterday, FOMC meeting, and normally during days of FOMC meeting, gold prices tend to move very violently. Whether it's up or down, you know, if you're having a position, normally you get very wary. So an advice for traders, you know, if you're someone that don't like so much volatility in the gold market in general, try to avoid trading on FOMC days, because during those days you have a lot of interest rate decisions, and during that time it will definitely affect gold prices. We have seen yesterday, you know, how volatile it is. I think the full range of the whole day market range for gold, I think it moved between $60 to $80 within that range. I think that's quite a big movement. So if you are someone new to the gold market and you don't like that kind of volatility, avoid FOMC days, because that would interest rate does move gold prices. Now, I mentioned earlier on the first point on the slide was global growth. Obviously, with global growth, you know, not looking good usually is beneficial for gold. Keep in mind, gold, in a way or in certain ways, still retain the safe haven status as an asset class. Now, usually I don't like to talk about central bank buying. When I was trading gold for the past couple of years, you know, when you try to analyze demand for gold, central bank buying was never a question, because central banks usually, some may sell, some banks will sell, and some central banks will buy, and the quantity is not much. But what's surprising is that over the past 3 months or so, the central bank buying for physical gold has actually increased tremendously. Firstly, we have Turkey. Now, Turkey, I think because of the depreciation in their own currency, the lira, they've actually purchased a lot of gold from the open market. That's quite shocking. Now, another country that's worth mentioning is China. Over the past 3 months or so, every single month they have been aggressively buying physical gold from the open market, and I'm talking not in terms of you know, kilogram, or they are buying in tons, and that's substantial. In a way, this is creating a bit of support for the market. Keep in mind, like I mentioned earlier, generally central bank buying and selling is not much. It doesn't contribute much to the overall demand for the market. But this time around is different. So I mean, in a way, it's puzzling, but it's good for us to acknowledge the fact that China has been aggressively buying physical gold for the past couple of months or so. And I think the latest data is still indicating they'll be buying more. And that's why, you know, gold prices tend to be quite supportive. If you look at, technically speaking, you look at the chart in gold prices, it's still well supported above the 1800. So this is something for us to watch out when it comes to central bank buying. Now, jewelry demand is another important factor to consider. Again, I think jewelry demand is quite stable year in, year out. You don't see 1 year there's a sudden surge in demand for jewelry. It's just quite difficult for it to happen in that sense. So really, I think when it comes to demand for gold, it always boils down to your paper demand, which is your ETF. And usually when there's huge inflow on ETF, demand for gold ETF, that will usually backed by physical gold, that will actually push prices of gold higher. So that is more of a critical factor to look at when you look at demand for gold. Now, other than that, geopolitical tensions is noted, based on historical lessons we've seen. Every time there's a geopolitical crisis, gold tend to be favored. Now, tensions are rising between the West and East. If you look at the news flow that's coming out in recent days, there's a pact between Russia and China against US. If US doesn't control the narrative well, it looks like they are losing, the war narrative especially in that region. So it's crucial to watch when you have tension in geopolitical space. Normally gold is a very strong beneficiary. So these are the factors that actually causes or I would say key factors to watch out whenever you are looking at gold prices. So just to share with you, the first factor was looking at dollar index and gold. You can clearly see whenever you have a strong dollar, gold tend not to be beneficial. And the relationship is actually inverse. So a strong dollar is not helping gold, but a weaker dollar is beneficial for gold. Clearly you can see every time when your dollar strength start to depreciate, you start to see gold prices going higher. So it's crucial to watch what if you want to understand more of the gold and US dollar relationship, understand the interest rate perspective as well. So what I have here is comparing US dollar strength against the US interest rate. Obviously, when a stronger dollar is accompanied by higher interest rate, that's given. When you have high interest rate, as what you're seeing right now in US, there's demand for dollar increases, that causes the US dollar rate to increase further. In other words, the strength of the dollar. And indirectly, that is not helping gold, because whenever you have a strong dollar environment, that is not beneficial for gold. Keep in mind also, when you hold gold or any other physical assets, this is the only asset classes that doesn't give you any interest. If you hold cash or whatnot, at least they give you a bank interest at the minimum. But when you hold gold, physical gold or what so, it doesn't give you much interest. In fact, it doesn't give you any interest at all. So when you have a high interest rate environment, there's always a high opportunity cost of holding gold. That is why as interest rates starts to climb, gold tend not to be benefits in that sense. So a key question to ask ourselves is that clearly we are in an environment where interest rates are rising, but gold looks like it's still gaining a lot of benefits in other factors. So this relationship, in a sense, it does hold historical in historical perspective, but going forward, like I mentioned earlier, there's a lot of dynamics of factors that can change the gold prices, which is also important to consider. But keep in mind, I think the dollar index and gold relationship still holds pretty well. Whenever you have a strong dollar environment, usually it doesn't benefit gold. Now, if you compare directly between the US interest rate, again, you can clearly see when you have a low interest rate environment, because that will weaken your US dollar, it tends to benefit gold. But when you start to have stronger interest rate and a high interest rate, that will make your US dollar stronger. And that's where you start to see gold prices tend to be a bit softer. So this is the relationship that we can draw. But again, these are all historical perspective. What drives the next phase in this relationship really all depends on also other factors that we have to consider. Now, I'm not going to touch too much on interest rate expectation, but this is an area where things are changing very rapidly. Now, I think the narrative in Federal Reserve has changed. The optic that they are using is they've changed dramatically. Over the past couple of weeks, they're saying that we're going to hike interest rate up to 5 or even 6%. Some even forecast to 7%, which is tremendous. Keep in mind, just early last year was still at 0 or 0.25. Right now, we are almost touching 5%. So that's a rapid increase when it comes to interest rate. And I think that's important to take note of, because as interest rates starts to rise, and that will put a lot of pressure in gold because of the stronger dollar. Now, I think just a couple of 2 weeks back with the banking crisis in US, I think that optic has changed. If you just look at even the statement from Jerome Powell, obviously he's still very adamant to bring inflation down by still hiking interest rate, but his tone has changed slightly to a bit more dovish. In fact, the market has also responded to that. In fact, I think probably the next meeting or so, rates may be stable. There won't be any hike, and they are looking at least a cut interest rate this year. So how that optic has changed is tremendous. You're talking about in weeks. Normally, it takes months for Federal Reserve to digest and adjust their policy. But I think market is the transformation in the market is very rapid. I think it requires Federal Reserve to be on their toes, and therefore I think they'll be very effective when it comes to changing their policies. So watch out. I think that's why I say I think second half this year, gold is going to be very interesting, given the fact that a lot of FOMC decision is going to be watched closely for. And if you are someone that doesn't really like volatility, try to avoid those FOMC days. Now, if you just look at yield against gold prices, you can clearly see there is obviously an inverse relationship. Again, this all points back to interest rates. As long as you have strong interest rate, high interest rate, that will mean higher or stronger dollar, and that will pressure gold prices. So that's how we link it up between the factors. Now, I just want to share this chart also as well. Clearly, you look at money supply as a factor. You can clearly see money supply has expanded in US quite tremendously. Actually, that's benefit gold. Keep in mind, we have actually came out from the gold dollar reserve. So therefore, I think the US Federal Reserve has a lot of leeway to print money. But that will actually fuel inflation. That's what we're seeing right now. Eventually, I think gold will be an ultimate beneficiary in that sense, because as long as government starts prints more and more money, I think investors will start to see that inflation is going to be a concern. And if you look at how historically gold has functioned, when it comes to inflation, gold has always been an asset classes that's quite good to hedge against inflation. So in that sense, you look at how the US Federal Reserve has been printing money for over the decade. There's a lot of money still flush in the system. So that actually create a lot of support for gold over the longer term period. Now, if you are someone that's in the equity space, you probably have noticed that the trend has actually turned downwards. This is interesting because if you look at Federal Reserve action of late, from a quantitative easing, they actually tightened their policy. That actually causes a sharp downfall in the equities market. Now, this is quite historical. If you look at every time when Federal Reserve starts to tighten their monetary policy, you start to see equities markets start to react. And it's probably true over the past 2 or 3 decades or so. Whether history will repeat itself, I think it's still much to be seen. But what you're seeing right now is pretty much in line with what historical data has pointed to us. When Federal Reserve starts to tighten, I think that's where we start to see equities markets start to adjust downside. So all these factors are pointing to supporting factors for gold market to rally. And I think eventually, if these factors continue to deteriorate further, it provide more support for gold prices going forward. Now, I'm not going to touch too much whether are we in a recession or not, but clearly, I think you just look at some of the data I pointed to you just now, some of the factors I pointed to you just now. Clearly, US economy is not on a good footing, and going forward, as long as those numbers are not showing you any sign of recovery, I think US will be in a recession very soon. And if you look at it, every time in periods of recession, look at how gold prices has performed. Over the past 3 decades or 4 decades or so, every time when US enter into recession, gold prices tend to perform better. In a sense that, gold does maintain its status as a safe haven, especially during times of turbulent times in the economy. So when you expect economy to enter into a recession period, gold tend to perform well. Now, this is basically gold. You look at during the bad times, if you compare to other asset classes like stocks or even the dollar index, which is supposed to be the king of all asset classes, no, it doesn't really perform well, especially during bad times. So the key question we should ask ourselves is that, how do we see the economy, at least for the US market, going forward in the next 6 months? If you continue to do badly, I think gold has quite a lot of potential when it comes to being a asset classes that investors rush to during bad times. Now, besides being a recession-proof asset, now how about faring against inflation? If you just look at US inflation over the years, we witnessed a tremendous sharp increase in inflation level last year, and we saw that how gold has actually reacted to that inflation environment. Now, in most inflation environment, gold tend to perform well as well. I think generally when you want to use an asset classes to hedge against inflation, commodities is the way to go. And gold is a particular asset, a commodity asset that they usually go for. So historically speaking, I think gold still remain very relevant when it comes to hedging against high inflation environment. That's what you're seeing right now. So if you ask me, what is the asset classes or what's the particular asset to go for, especially when it comes to high inflationary environment, I think commodities is definitely a must. Over the past few cycles or so, we can clearly see, I think commodities is always benefits when it comes to high inflationary level. And in terms of commodities, gold also tend to perform well when you have high inflation environment. So in that sense, really, I think gold tends to perform well, especially when you witness inflation rising across all asset classes. Now, I'm going to compare this, comparing gold prices and unemployment rate. I clearly shared with you earlier on that when you have low unemployment rate, normally, that tells you the economy is doing well. And again, it points back to the narrative. When economy is doing well, that will not benefit gold. The key thing is that when unemployment starts to increase rapidly, and that's usually beneficial for gold. Now, these are all headline numbers. What I've shown you earlier in the slide is also to point to you some of the figures that's underlying employment figures, and that is painting a slightly different picture. So as long as you're hearing more tech layoffs coming on stream, that will put a lot of pressure on your headline unemployment numbers. So eventually, the unemployment numbers will inch higher. So if that's the case, again, I think that will give a bit of support as a factor to support gold prices going forward. Now, whether VIX basically as a factor or not, VIX itself is just basically a measurement of fear. When you have high VIX reading in the market, that tells you generally there's fear in the market. We have seen that back in early 2020 at the start of COVID-19 pandemic. We saw VIX index actually climb to as high as 80 index point. So that tells you there's a market fear. And clearly you saw how the gold prices had reacted. It actually rallied to all-time high at about 20.50 per ounce. Obviously, that has since retreated. Gold prices have retreated because the VIX index actually normalized. What is crucial to watch over the past couple of days, VIX index starts to point higher. In fact, it was doing about 30 index points. So that tells you generally the market is fearful. So when market is fearful, that's a good indication that a lot of sentiment is flowing back into gold as a safe haven asset. So crucial to watch. You can use this as a barometer to gauge where the fear of the market is. As long as there's still persistent fear in the market, gold prices tend to benefit. Now, if VIX index starts to decline, that means fear is pretty much subsided in the market. Generally, in that condition, you expect gold prices tend to decline. So I think VIX is a good measurement for us to gauge how the market fear is. Right now, I think despite there's a government backstop in trying to solve the US banking crisis, there's still lingering fear among the investors whether that crisis can still persist. That's why the VIX index is still not going down to its normal levels. It's still quite elevated. It's something to watch out. I'm not saying this is a particular factor, but it's more of a gauge and a barometer for us to use whenever we want to understand how the market fear is, the sentiment of the market. So right now, I think market is generally still quite fearful, and that's supporting gold prices at the moment. And now I'm not going to go too deep on explaining what happened to the banking crisis, but I think it's more it's more important for us to understand that because of the rapid rise in interest rate in US, that has a lot of repercussions, and obviously it creates a lot of havoc between the banking community, and in that sense it creates a lot of panic, and again that explains why the VIX index has been climbing. Now, as long as this plays out, there's still lingering doubts among the investing public regarding the banking strength in US. I think that again will support the narrative for gold. I'm not going too much on credit conditions, but this tells you this that generally when you have high interest rate environment, that's where you start to see a lot of foreclosures happening. Business sentiment starts to get weaker. Because generally when you have high interest rate, that means higher cost on your debt. And if you can't service that debt, that means you go to foreclose. And that would actually tighten credit for the banks. So crucial to watch, how rates are going to play out. That's why I mentioned this next 6 months or so is going to be a very interesting time for especially for the US interest rate and for the gold market. Because obviously when you have different interest rate path, gold will definitely react to it. And as a trader, you definitely like that kind of volatility. So going back into demand, I think basically demand and supply for gold. The supply for gold is actually very stable. There's nothing much to talk about. It's only more on the demand side. Now, demand usually is very the important factor to drive demand for gold is basically the paper demand, which is the ETF. So as long as sentiments are not there, global sentiments is weak, normally they usually demand more gold. And I think pretty much you look at it, the gold back ETFs, the inflows that's coming into the ETF is actually quite massive, or at least for the past couple of weeks. Now, I'm not going to go too much on geographical regions, but it's good to take note that US is still quite top in terms of the league table. They are still holding the largest reserve of gold in the world. But what is critical to watch is another country that's coming up quite rapidly is China. Now, you just look at this year alone, China has probably increased in terms of their gold reserve by almost 62 or 80 tons. And again, these are all pretty much on a monthly basis. And it's quite massive. You talk about in tons, which is China, which is usually not a very big buyer of gold. Suddenly they've been buying a lot of gold. Now, whether they are preparing for something that we have not probably going to foresee in the future, that we might not know. But given the data that's showing that China is aggressively buying gold, I think that's positive in terms of demand. Now, this just to show you the composition for China in terms of their gold reserve has actually been increasing quite tremendously, especially for the past 2 years or so. And last couple of months, we start to see a lot of physical buying from China. If that continues, I think that will provide a bit of support for gold market in terms of physical demand. Now, jewelry demand is another aspect which another important factor when you talk about demand for gold. India and China are the two largest. Again, there's nothing much to talk about when it comes to change in demand because demand for jewelry demand for gold tend to be quite static year in, year out. You don't suddenly expect this year, India to purchase more gold in a massive fashion. Obviously, there's increase or decrease, but we don't see much of a big impact when it comes to gold prices. But again, these are all supporting factors that support gold prices because, like I mentioned to you, economics 101, you have higher demand, supply is stable. That will tell you prices tend to be on the higher side. So that's how we view jewelry demand as a factor. Now, I think worth to point out is that the central bank buying has been actually quite aggressive. Whether there's agenda behind it, really, we wouldn't know. But it's something to watch out for, at least for the next couple of months. Now, Turkey is because very clearly they are suffering from a devaluation of their own currency, so they are buying gold in a way to back up their currency. But unfortunately, they were badly hit by the earthquake in recent months. So that buying has actually been stopped or they slowed down a lot substantially. But what is compensating those numbers is actually China. China has not slowed down on their aggressive buying for physical gold, at least for the past 3 months or so. So as a result, if compared to central banks buying in totality, we saw a sharp increase back in February and January figures because of China. So this is what I was trying to share with earlier on, that China total gold reserve actually increased rapidly, at least for the past couple of months or so. Now, in terms of supply, there's nothing much to talk about. The supply for gold is actually pretty fixed. There's always a fixed supply, whether it's above ground or underground. And I think because of that, it's more of the demand dynamics that one have to watch out for whenever we want to discuss about the demand and supply dynamics of gold. Now, the reason I want to share with you this chart is because I know, given the fact that we understand the fundamental perspective, especially for looking at the gold market, understand the various factors that can affect gold prices. If you're trading a futures market for gold, it's important for us to understand net positions in the market. Why is it important? It's for the simple fact that if you are in a market where prices start to see a big rally, and if those positions are not accompanied by net long positions, the market is telling you that this rally may not sustain. So imagine this principle. If during a big rally in a gold price, is what you're seeing right now, if the net long positions are not increasing, generally it tells you that people are actually using this rally to get out of that position. Now, if this rally is able to sustain itself, it's very clear cut that people will take positions to hold, or net long positions to hold against, to hold with the trend. So that it tells you a lot of picture how the sentiment of the market is, especially when you see a big trend in the market. And I think this net long and net short positions, which is a vital data that provides on a weekly basis, it gives you an assessment of how the market sentiment is. So we saw a big rally they are seeing in gold market in recent times. And true enough, the net long positions actually been increasing. So it tells you that the market participants in the market is still holding up to the rally. And important to watch, if this net long position starts to decline, especially during a rally like this, it tells you that generally, I think those who have long earlier on in the rally will start to come out because the net long positions will start to decline. So I think it's important indication for us to take note when it comes to understanding commitment of traders report, which indicates to you the net long and net short positions on a weekly basis. Because with that data, you're able to determine whether the market is pretty much supporting the rally or is actually getting up, especially for some of the crucial market participants. Now, another principle, if you are trading the futures market, the gold futures market, regardless whether it's gold or any other futures market per se, the thing about open interest is that, when you see a big rally in the market, price rally in the market, it usually must accompany by higher open interest. Why is that so? Again, goes back to the previous principle which I shared earlier on. Whenever you see a strong rally, if there's more market participants supporting that rally by higher open positions or net positions, that means the rally can still sustain. But as long as an open position starts to increase or starts to decline, that's where you need to be careful. Normally, if during a massive price rally, if the open positions are not increasing, it gives you a bit more doubt as to whether the rally can continue. So open interest and net positions will give a bit of dynamics when it comes to understanding the market sentiment, whether can the rally still continue on its own. Now, I'm also quite a big fan of understanding price seasonality. Now, commodities in general, the reason why I trade commodities as compared to other asset classes is because commodities tend to display a pattern. Historically, there's a pattern, or rather there's a season where particular commodity will display strong prices, and there's also a period where particular commodity will display weaker prices. Now, if you take, for example, like palm oil, for example, normally, year end, prices tend to be stronger because production is weaker and demand tend to be stronger. So those are what we call periods where we witness stronger prices. Now, if you look at gold, in general, there is also a season. But obviously, gold seasonality may not be that of a stronger impact as compared to other commodities like palm oil, for example. But it does give you a gauge. So normally around August, if you just look at over the past decade, 1 decade or so, August and pretty much December is what we call strong periods in the market. Now, weak periods are usually September, October. That's where there's a lot of strength in the equities market because of the quarterly report. And when strength in the equity market, it will actually be not benefiting the gold market. Now, the August seasonality impact is more of the physical jewelry demand because India is usually their season of buying gold. And usually those are the period where they start to buy a lot more. So that's where you start to see this kind of pattern. And obviously December is year end, another period where there's a lot of physical buying as well. So, these are pretty much the seasonality for gold. Now, you can't use this as a way to position your trade. You can use this as a guide. If you're looking at, or you're entering into periods where prices tend to be weaker, so usually at those times you should be finding opportunity for you. If the trend is down, find an opportunity for you to short the market instead of try to pinpoint the reversal in the market. So these are some of the guides that you can use whenever you look at the gold market in terms of seasonality. Going to the last part of the presentation, I think talking about technical strategies. So now, a lot of examples I shown earlier is actually based on COMEX Gold. The prices are based on COMEX Gold. Now, FGLD right now, the new REM contract is also based on US dollar rates. So you don't be confused of the conversion. So whatever you see on the screen right now on the FGLD contract is actually quoting you on a US dollar per ounce basis. Now the multiplier is about 40 for each contract. If you track closely between FGLD price and COMEX Gold price, they're actually quite in line in certain ways. There's obviously certain period of discrepancy, but the discrepancy is actually very minimal. You're talking about only a few dollars. So I would say that between these two products, there has a very close linkage. Obviously, if you go to smaller time frame, again, you can clearly see an even stronger linkage or price similarity between the COMEX and the FGLD contract that's being traded on the open market. So with that, I think if you want to gain exposure in the gold market, I think FGLD is quite a good contract to consider. Now, going to technical side of things, if you just look at the chart itself, a way to determine trend, there's a couple of ways. One, you can look at visually. I always like to use exponential moving average for us to entail whether the trend is uptrend or downtrend or a sideways market. One of the ways is actually comparing a 20 period together with a 50 period EMA average. So as long as prices are trading above both the EMAs, it's telling you the market is on an uptrend. Clearly, you can see there's a strong uptrend back in early 2020 at the start of COVID-19 pandemic, and that causes a massive rally in gold prices. Now, the key thing is that I think late last year, early this year, we saw that prices of gold trying to retest the 50-period EMA. So I think that's crucial. If it does break that, that tells you generally the market is actually on a downtrend. But it didn't. I think it's well supported at a 50-period EMA. In fact, I think market right now is still trading above the 200-period and the 50-period EMA. It indicates to you that the market generally is still going to be on an uptrend. Now, this basically tells you the volatility of the market. So why I said that now is a good time for you to look at gold market is because as a trader, we like volatility. Now, if you are trading back in the early part of 2021, you probably have noticed that, the daily range in terms of gold price may not fluctuate that much. Then obviously during the early part of last year, we have the Russia and Ukraine conflict. I think that pushes gold prices rapidly in terms of the volatility. Now, last 2 weeks ago, we start to see this volatility start coming back again. Now, as a trader, we definitely like volatility because without volatility, we can't see much of a price action, and that's where as a trader we want to find opportunity. So right now, I think you can clearly see the volatility of the gold market has returned, and indeed, I think as a trader, it gives you a lot of opportunity to be in and out of the market. Now, for myself, I think the style of trading is pretty much trend trading, and I think one of the good indicators that we can always use is what I always call as a Heikin-Ashi candles. It's just a derivation of Japanese candlesticks. It's different from your normal Japanese candlesticks in a way that it indicates to you the trend in an easier fashion or easier manner. There's only 3 simple steps that we have to follow, especially when you look at Heikin-Ashi. As long as it's pointing green candle, that tells you generally the market is on an uptrend. Red candle, that tells you the market is on a downtrend. If you have a series of short red and green candles, that tells you the market is actually sideways. So if the trend is going into a sideways market, that is the time where you need to be careful. So it's just 3 simple steps. So it's just showing you a sample chart of the FGLD using a Heikin-Ashi. You can clearly see these bars, green bars, is pointing to you a strong uptrend. Then the market goes in a sideways fashion where you can start to see series of red and green candles. During that time, normally the market is trying to tell you it's on a sideways market. Now, if you see a series of red candles, that tells you generally it's going to be a strong bearish trend at the immediate point in time. So as if the candles are white and long, that tells you generally the strength of the trend is very strong at that point. But as the length of it gets shorter and shorter, that tells you generally the trend has actually loses momentum, and you have to be careful. When the trend loses momentum, that usually be a point where it starts to change the dynamics in the market. So using Heikin-Ashi, it can clearly indicates to you a period of time where where the trend is up and period of time where the trend is down, or in fact when the trend is going in the sideways market. Now, this is on COMEX Go. On a 30 minutes time frame, you can clearly see again, when you see a series of green candles, that tells you generally the market is on an uptrend. If you see a series of red candles, that's where generally is on the downtrend. Now, look at this particular sharp rally and a sharp down rally. Now, this is what you usually expect normally on a market news movement. Usually the market move in anticipation of the news, and if the news goes against the market consensus, generally the market will reverse very substantially and quite rapidly. Now, as a trader, if you want to avoid those days, it's better, because if you don't like volatility, I think without proper risk management, you can easily get swing by the market. So these are the things that we have to be very cautious of, especially when you use Heikin-Ashi candles. Another thing about, if you notice in the past two slides, when I show you the Heikin-Ashi, is that you notice there's no gaps in the frame itself. In a normal Japanese candlesticks, there's always gaps. So if you are someone that's using gap analysis, understanding gaps, whether gaps are filled or gaps are not filled, using Heikin-Ashi, it won't give you much of analysis. So that's, I would say, a bit of a downside when you use Heikin-Ashi. But when it comes to color indication of whether the strength is there, the trend or the strength is still relevant, I think Heikin-Ashi is quite beneficial. So just to give you an example here, so I just taken a very snapshot of the gold market just past couple of days. Now, if you just look at this particular candle highlighted in this circle box, so if I would ask you, without looking at the next couple of days, at this point in time, will you be taking a long or short positions? Now, I just want to be interactive with the audience. Hopefully, you can get the Heikin-Ashi dynamics. So, will you be buying or will you be shorting at this point in time? So maybe you can just type in the chat box. Sorry for spamming the chat box, but I just want to get a feedback from the audience. Okay. So generally, there's a lot of feedback that's coming back. So sorry. Just to highlight, because I saw there's a comment that says that if you see a green candle, no, it should be a sell. No, green candle usually indicates you the trend is strong. It's an uptrend. Usually indicates you buying opportunity, and vice versa. If you see a red candle, that indicates to you a selling opportunity. So obviously, a lot of answers from the audience is pretty much on the buying side. There's some couple of answers. Feedbacks is saying that probably want to wait for retracement, probably the market can go sideways. You want to be patient. That's all fine. There's no right or wrong in the answer. But let's see how the market reacted. So the circle part was where I highlighted on the previous slide. And true enough, if you just follow on to the Heikin-Ashi candle bars, the market did indeed rally in the next couple of sessions. Now, obviously relying on Heikin-Ashi to identify trend may not be sufficient. There's bound to be periods where you get whipsaw or you hit your stop losses. Now, this is part of trading. There's no 100% hit rate, or there's no 100% foolproof method. Whatever method that you use when it comes to trading, it's always about probability. You just have to ensure that whatever you profit must be bigger than what you risk to ensure your profitability in the market. So I think using Heikin-Ashi may not be only sufficient. I think it's also good that we can incorporate moving averages along. So what I did here is basically incorporating the 9-period and the 20-period EMA average. So moving average crossovers are simple. Crossovers. So a bearish crossover is identified by the shorter period crossing the longer period below. That is bearish crossover on the EMA. So if you accompany that with Heikin-Ashi candle, so if the Heikin-Ashi is red candles and it's a bearish crossover on EMA line, that's a very good indication for you to short the market. Vice versa. Now, if you look at this particular circle, red circle line that I showed earlier, you have two signals here. One is you have green Heikin-Ashi candles, and you can also see a bullish crossover on your EMA. Why is it bullish? Because you can see that the shorter time frame is crossing above the longer time frame, which is indicating a bullish EMA crossover. If you see a green Heikin-Ashi, that means it's going to be an immediate short-term uptrend in the market. So it's a very good opportunity for you to identify a good buying opportunity at this point in time. So again, to relate to you the dynamics of it, you can obviously use a MA crossover accompanied with a Heikin-Ashi to give you a better signal when it comes to identifying buying and selling opportunity. Now, I just want to share with you this particular chart. For example, I think there's a lot of concern I've been getting is that at the start of this contract, at the start of launch of this contract, the interest in it was still quite minimal. But if you just look at the volume itself and open interest, actually gained quite substantially over the past couple of weeks or so. Daily volume is probably about 50 to 80 on average. The key thing is that open interest is also starting to increase. That means people are willing to hold into positions in FGLD contracts. So I think these are all good signs that there's growing interest in the particular product. And as I mentioned earlier, what are the factors that actually support gold prices? That will give you a lot of reasons why you should be looking into gold market, in particularly this year or so. So why FGLD? Now, like I say, I think they revamped the contract to make it more attractive, to make it easier for us to gain exposure in the gold market. Now, there's a lot of it can get very tedious if you don't look at there's a lot of ways for you to get your exposure in your gold market. You can obviously go into a physical market, you can buy gold bars and whatnot, but those are quite tedious. Now, in futures market is very easy. Just need to open an account with a licensed broker, and there you can kickstart your journey into trading the gold market. Now, since the revamp of this new FGLD contract is actually based on a fixed multiplier of 40. It's a quanto contract. So technically speaking, you're looking at FGLD prices quoted in USD prices, which is similar to your COMEX gold prices. So in other words, you don't have to do the conversion in your head. It's as simple as looking at the gold price and make a decision. And also because there's a fixed multiplier, indirectly there's you lessen your currency exposure. And obviously, I think with that, it gives you a lot of advantage of holding gold over other types of gold forms. And I mentioned earlier, gold is still a very good safe haven assets. In times of crisis, in times of tension, gold has not failed in many regards. Now, external markets, if you look at the factors I've shown to you earlier, the dollar index, the interest rates, these are the two pretty much dominant factors that actually can fuel or drive gold prices. So as a trader, you really want to watch out, especially when it comes to FOMC meeting. You want some excitement. I think gold is quite a good contract for you to look at. Now, I showed you earlier, a lot of misconception was that FGLD tend to lag behind COMEX gold prices. Now, if you look at it on pretty much on a small time frame or even on daily time frame, although there's still periods of discrepancy, but the difference are pretty much quite minimal, and it track quite closely with COMEX gold in particular. So I think it gives you a lot of opportunity. You want to gain exposure instead of going to the COMEX gold market. You can gain exposure right here, in the market that you're quite familiar with. So FGLD provides you that kind of platform for you to gain that kind of exposure. So basically, this is the contract spec. I just want to point to you the contract timing. Now, trading gold, it can be quite tiring given the fact that gold tend to move quite closely to the US markets, in a way that when US start to release their economic news, start to release FOMC minutes and whatnot, that's where gold prices tend to move, and that usually be the non-Asian hours. But during those days before the revamp of the contract, you don't have that kind of opportunity, because once the market closes at 6 p.m, that's it. There's no night market for you to gain your exposure with. But this time around is different. I think with the new revamp, they've extended the time. Right now you can trade gold right until 2:30 in the morning. So it gives you a lot of opportunity, especially you want to trade the US market to during the FOMC days. You can clearly trade because those are the times where it gets a bit more volatile. So just to share with you the campaign, I think right now Bursa Malaysia Derivatives is actually extending trading and clearing fees waiver until June of this year. So if you can trade this product at a lower commission, and it helps you in a sense that to at least understand how the market works, and ultimately starts your journey into trading the gold market. So with that, I'm just going to end here. Just going to pass it to CY